Welcome back to the channel and welcome back to History in the Making again here today in 2022. We had a very positive CPI report, the biggest beat to expectations in all of 2022. On the month over month, that was almost in deflationary territory. The year over year reading was much better than expectations. You couldn't have asked for a better CPI report within reasonable expectations. A matter of fact, this CPI print that we got was only a 15% probability by JP Morgan, and they estimated that the stock market would rally 4 to 5% off of a 7.1% reading. Less than a 15% chance. Well, it actually happened, and you did rally about 4% in the NASDAQ, and you rallied about 3.5% at the peak for the S&P 500. But how today played out is not very comforting for the bulls out there. We literally closed at the same prices that we were at before the CPI report came out. So you gave all of the gap up, this gap up from the CPI initial release, you gave that all away throughout the trading day today. And there's a lot of reasons for this, right? Let's not be blind here. There's a lot of reasons to be selling off on a good CPI report. The biggest one of which is valuation concerns. As we get closer to actually starting 2023, these estimates are coming in and they are super low. So if these estimates that we're getting are correct, you're still much too high on the S&P 500. And that is a big problem. At the same time, tomorrow we get the summary of economic projections in which that will say where every individual Fed member thinks interest rates will go and when they will eventually be cut. So markets right now are pricing in rate cuts by the second half of 2023. On one hand, rate cuts are negative. That's the most negative thing you could get, because why would the Fed be cutting rates after the inflation that we just seen? So on one hand, the Fed cutting rates a lot sooner could be bearish and would be very bearish. Also, at the same time, if the Fed keeps interest rates at 5% throughout 2023, that's also bearish. So it's like, where do you win in this equation? And it's becoming very hard to see this soft landing prospect, at least in the stock market, because there's just no good that could possibly come out of any of this, guys. So we're going to get into everything you need to know about the report coming tomorrow with the Fed, and this is going to be the biggest report and really data from now until the end of the year and even into January, until we start to get a lot of company earnings coming out. This is going to be the bread and butter, the meat and bones of why the market is going to either rip to the upside or potentially get close to those new lows even by the end of the year, guys. So let's get straight into it. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you have not already. First things first, guys, just to round off the conversation we were having in the beginning of this video and to put it just right out there for you guys. The two most important things of tomorrow, of the actual FOMC meeting in general, it's not Fed Jerome Powell speaking. That will be important, but that is not part of the two most important things. Two specific things that will either crash the markets or make the markets rally is the terminal rate. Does the terminal rate go higher than 5%? And if it does, how high above 5% does it go? Really, anything over 5%, or I should say 5.25%, is probably going to be seen as very negative. If you're closer to like 5.75%, 5.75%, not going to be a good thing. Probably going to see a 4 to 5% down day tomorrow. On the other hand, and I think this is more likely to cause downside in the markets, is how long do rates have to stay at these levels? After tomorrow's FOMC meeting, the federal funds rate is going to be at 4.5%. That means you have 150 basis point rate hike to go or 225 basis point rate hikes to go, and then they're done. If they just keep that 5% interest rate throughout the whole year, That is breaking market expectations. Markets expect the federal funds rate to be about 4.5 to 4.75% by the end of 2023. That implies at least one rate cut, if not up to two rate cuts towards the end of the year. Now, like I said, this is where it gets into that how do you win kind of scenario, because if the Fed's cutting rates right when they stopped raising rates, that's a bearish thing. And historically, that has always caused stock market crashes. And if we go and pull up the federal funds rate for you guys, you'll see exactly why. The economy can do very well during rate hike cycles. It's not until the Fed starts to cut rates where typically the recession comes and the downside in the markets. That's why 2022 has been so interesting, because usually you rally and the markets go higher during a rate hiking cycle. It's not until after the Fed raises rates and starts cutting rates where typically the markets actually crash. You can see this perfectly from 2015 through 2019. You can see this picture perfectly from 04 to 07. These were great times to be in the markets, but the Fed increased the federal funds rate by 500% during this time, from 1% to 5.25%. And then the recession came. And then the downside in the markets came once rates were cut close to zero. And same thing throughout all of history. So it's becoming to look like one of those things where there's no good ending to this story. So there's that information, and that's going to be the most important thing for tomorrow. And if today was any kind of semblance of what tomorrow's going to look like, it could be very bad. Now, don't let my commentary sway your decision. I'm not a financial advisor. I don't know what these numbers are going to come in as. I don't know what the Fed is going to do or say. But based off of a record slowing of inflation that we got today, the market's completely splatting that off and selling that down. Tomorrow looks to be very, very choppy, guys. So there is all of that. Now, you have been seeing major banks coming out and lowering earnings expectations, and that is a big thing and a big reason why this CPI report was also brushed off, because at the end of the day, you can trade lower on the Fed raising rates, you can trade lower on a lot of things, you can trade higher on a lot of things. But once fundamentals become questioned, once you actually look at earnings decelerating, then the question is, where should stocks be valued? And that's what we're starting to see with some banks, cutting forecasts for S&P 500 earnings by 10% or more. That's a big problem. That in and of itself implies a recession. And now you have Citigroup, Bank of America, Goldman Sachs says will probably be around 0% GDP, so it still would be a technical recession. Merrill Lynch, just basically all the major banks are calling for another crash in 2023, a bloody first half of 2023, and that could potentially start right now. So that's why this is all very, very important, and this could be a major pivot point and an opportunity for you guys to make some sick profits if you do catch the market downside. Now, the actual numbers for the consumer price index that came out today came in at 7.1% from a year ago. The expectation was 7.3%. And the month over month was the biggest thing that caused this gap up in the morning, because we only rose 0.1% month over month. The estimate was 0.3%. So you're almost in month over month deflationary time frames, right? From October through November, you almost seen deflation. That's what the Fed wants. But even with this beat, the market still sold it off. You gotta be quite skeptical of what is going on, guys. So there is that. Now, for tomorrow, we ran through the Fed. That's basically going to be it. You don't have any other data points that are going to be coming out, nothing that is going to move the market. So I do expect the first half of the day to be pretty slow up until about 1 p.m. I think things will speed up heading into 2 p.m. when you get the actual FOMC report. And then following that at 2:30, when you get Fed Jerome Powell that will be speaking, guys. So there is all of that information. If we take a look at the S&P 500 option activity here today, you will see, let's go ahead and let this load. There was a lot of activity today. 9,200 orders on the S&P 500 alone today, worth almost $1 billion. $991 million, positive order value of 70%. So it looks like people are quite bullish for tomorrow, which is very interesting given what we've seen today. But you've still seen a lot of put positions coming through, but you did see a lot of calls at the same time. Some of this might be hedging out some of these put positions. You never really know, but you did see a healthy amount of option activity on the S&P 500 here today. So some of the bulls, that's a good sign. Now, if we take a look at the live short interest numbers on the S&P 500, we are getting about 15%, which this is also another very bullish thing. People are not really shorting the S&P 500 right now. The short interest is not that high relative to where it has been throughout 2022. Cost to borrow rates did spike up, as well as premiums today, anticipating that data release coming tomorrow with the Fed and the new information that we will get tomorrow, guys. Now, let's go ahead and wrap up this video with some technicals on the markets. But before we do that, let's talk about bond yields, guys. And this is one of the things that is really stumping me the most, that leads me to believe a recession is right around the corner and some more downside is coming for the stock market. Because even though the markets sold off pretty much all day after that initial gap up, the bonds, they did fine today. I mean, they were higher, but they closed up 1.22%. Relatively speaking, this was a lot stronger than the move in the stock market that you've seen. And if you guys are unfamiliar, TLT is the 20-year treasury. It's the ETF that tracks that. When this chart goes up, when the actual price of TLT goes up, that means bond yields are falling. That means there's more demand for bonds. So if there's more demand for bonds, the bond yields don't have to pay out as much because people are buying them, right? It can be a little confusing, but it basically works like a dividend stock, essentially, right? Long story short. Now, what you have seen, this is the rally in bonds that you've seen in August that pushed the stock market up to 430. That caused this rally in the stock market back here. Very, very violent rally. But what you have seen is an even bigger rally in the bond market since then, but stocks have not played along with that rally nearly to the same extent, and you're seeing stocks that are selling off on a day like today where the bond yields are actually dropping a lot. So the question is, are investors buying the bonds because they're fearful about economic growth, or they think inflation really is going to come down? I think it's a little bit of both, but it is not a good sign. Now, UUP, this tracks the US dollar. This did go down today, which is very good, down about 1%, fundamentally speaking, a very positive thing. Now, if we pull up the S&P 500 technicals here, guys, I've had these lines still drawn for a very long time, and you can see the markets are very much respecting this downtrending level of resistance, and it did yet again today bounce off of that level and did respect that level. Now, we do have this a shorter term from October 13th, the low of the markets, this ascending level of support. And what you have seen is 1, 2, 3, 4, 5, 6, 7 touches to this, and then you did get that initial break, and you're seeing more resistance around this level. So it looks like you're in a situation where the markets are probably at least due to come down to the 100-day moving average, which is at about 391.66, and that's where I would expect to see, the markets go if we do have a bad day tomorrow. And if we did have a bad day tomorrow, that would put the S&P 500 dropping about 2.5%. I think the worst it could get is about 5% down, and that would be putting the markets around 380 on the S&P. If you own puts, it would be a very good day for you tomorrow, guys. Volume was higher on the S&P as well, about 123 million shares that traded hands today, but nothing out of the ordinary for the S&P 500, but just a massive swing, another record day for 2022. But this one is a little bit more worrisome, guys. So the bull case here tomorrow, you break out above the 410 level, in which we did see the intraday high today of 410.49. The pre-market high was 414. If we can break above 410, it's going to be a very good sign heading into tomorrow and even after that, the end of the year. If you do not break 410 tomorrow, you're due for some pretty big downside. The risk to reward does not look to be in your favor being long at these levels, guys. So that is going to be it for this video. We could go on and on and on. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Thank you guys for watching. My light did turn off a while ago. We'll see how many of you guys noticed that in the comment section. Most importantly, enjoy the rest of your day, and I will see you in the next one.